Dr. Pawan Goenka joins us now, and he's going to be a very, if I may say once again, very happy man, because the markets are rewarding to what they've been trying to do. Sir, let's start with a smile on your face.
Yes,
10% higher for Mahindra and Mahindra, and it is all after the conference and the good numbers. The stock is up 10%, courtesy, demand, management commentary, and good indication on capital allocation. So this is a reward coming to your shareholders from markets.
Yes, Nikunj, I think if I could say all the pieces are coming together well. If you were to go back year and a half and talk about what were the concerns that any investor would have in Mahindra, and if you look at where we are today, I think most of those concerns have been fully addressed. And if I could sort of take them one by one of the concerns, of course, always was capital allocation philosophy of Mahindra. We made a very major announcement in April saying that we are going to be very prudent about capital allocation, driven partly by COVID situation and partly by strategic rethinking and realignment in the company. And I think what we have done this Friday is once again proven to the investors that our resolve for capital allocation is absolutely serious. And we have demonstrated by our actions that we are willing to take very tough calls in order to get our capital allocation right. So that is one very big thing that has happened. The second big thing that has happened, Nikunj, is the fact that our overseas subsidiaries, which was a concern for the markets, that are we putting in a lot of sort of investment in overseas subsidiaries, and will that really create value? We had now 2 quarters of positive profit for all the FES or the farm equipment overseas subsidiaries. And I think that also now demonstrates that we are up on the growth path when it comes to overseas. Third is fear that during COVID, will the company be able to manage their operating business of auto and tractor in a profitable manner? And again, thanks to the demand buoyancy that we have, which continues in third quarter, we have had almost the best quarter ever in terms of financial performance and also in terms of sales when it comes to tractors. And the fourth is the positivity coming because of the very successful launch of Thar. And there was some concern earlier about some of the last launches not doing very well. And when you add that up, you see a full story coming up in the core business. And then when you look at what is available as what we are calling gems, and the kind of things that could happen there, a kind of monetization that is beginning to happen, and the platforms that we talked about on Friday, the porter and so on. I think this is all creating a very positive sort of story for where Mahindra Group is headed and where Mahindra and Mahindra is headed. And I think that's the result that we have seen this morning in terms of how investors have rewarded the stock.
So I'll ask you strategic questions, Mr. Goenka. There's no point in getting into what happened to steel prices and rubber prices the last quarter, because those are moving parts. You are at a cusp of operating leverage kicking in, which is demand, and financial leverage kicking in because of your capital allocation policy change. If you combine both of them, where will the return ratios for Mahindra and Mahindra settle for next 3 years?
Obviously, I cannot make such forward-looking statement, and it's very difficult for me to predict that, and anything can happen. But what if I could sort of give you a qualitative view of where we are, and then you can draw your own conclusion. First of all, let's say that we are very well capitalized, right? In terms of fund situation, we are in a very comfortable position. No matter what happens, we will not have any kind of cash crunch, no matter what happens. That's number one. Number two, we have a very strong product pipeline. Okay, the Thar has obviously done very well, and then we have 2 new products coming up, and in tractor we have the K2 product coming up. So very strong product pipeline. 3 very important things that we have talked about looking at the future, and that we have done only in the last month or so, is doubling down on electric vehicles. Now, we have always been the first mover in electric vehicles. We started 10 years ago. We have kind of focused on shared mobility. And now we have made an announcement that we're going to go fairly heavily onto personal mobility also with the Born Electric platform. And that's the sort of flavor of the day in terms of where the auto industry is moving. So that's the third one. And the fourth, in terms of tractor industry, our sort of leadership position continues. And what is very gratifying to me is that now all the investments that we had made in international subsidiaries, the MAM, the Hisarlar, the Erkund, the Sampo, Mahindra USA, all of that is beginning now to turn around and pay off. So if you were to add it all up, I think we have a fairly good future. I would hate to put any kind of numbers around it, but I think we are right now sitting in a very comfortable position for the future.
You'll have to give me some numbers, sir, because what you've indicated, I think, is more like a vision statement. But when Pawan Goenka is on show, he has to give me some numbers.
Okay, what numbers do you want?
What I want to understand, Mr. Goenka, is that one side is the whole operating issue which will come in. Second time is the capital allocation which will keep on improving because of a loss-making subsidiaries will come down. When will these two numbers, where will the convergence happen for you?
What do you mean by convergence? I guess I'm not able to understand that point. Are you saying when will we be done?
No, my whole idea on convergence was that when will the return on equity and return on capital will start booming up? Because that's the turning point for Mahindra and Mahindra, which was clear in your last quarter numbers. So I'm trying to understand that when will this uptick settle?
So I think right now what is sort of slowing down on ROE and ROC are the various impairments that we are taking to clean up all the capital allocation. The very big hit that we have taken on SsangYong in this quarter is 1,200 crores. None of these are cash losses because we are not putting any money into SsangYong. These are just impairing our past investment. And therefore, once that is done, and we are pretty much done because SsangYong is now, we have impaired almost everything that we have to impair, and it's very unlikely that we have to impair anything more. We have impaired many of our foreign subsidiaries where we don't see a future. So I think the impairment is more or less over. And impairment is what is driving down the ROE and ROC. So once you take those out and you look at a financial performance without impairment in this last quarter, I think that gives an indication of where we are headed. And the other thing that will make a very significant change in the financial performance will be as soon as the supply constraint in auto are taken care of. Because right now auto was somewhat subdued because of supply constraints we had in the quarter. Demand, as I've said earlier, is very buoyant, and we can easily sell 5,000, 10,000 more vehicles per month if we had the supply constraints removed. So in a sense, Nikunj, I would say convergence has happened, in a sense, okay? We will continue to make improvements over it, but convergence has happened because we have taken care of the operating performance now. Very good cost management, thanks again partly due to COVID. Very good margins that we are getting. Less pressure on discounts that we used to have, say, pre-COVID because of shortage situation. Obviously, there's less pressure on discount. So that's all taken care of. So just remove from the financials the impairments, and that gives an indication of where we are headed.
Okay, thank you for explaining that, Dr. Goenka. My next question is, when we look at the medium-term outlook, there is reason to get optimistic. The budget was great, demand is strong as a country. Touch wood, we've not got impacted because of COVID, unlike other developed countries. But when there is too much of good news, sometimes we ignore the obvious bad news. Like our common friend Rakesh Junwala always says that worst of the mistakes are made in best of times. What is the fear which everybody is ignoring?
Okay, so do you want to look at industry-wise or overall economy?
Both, sir.
Okay, so let me first talk at the auto industry level. Okay, the auto industry in the short term, and I would say that, let's say for the next 6 months, the two big sort of elephants in the room are the supply shortage. And this problem is, as you know, global problem. So it's not a problem where we can do something quickly and the problem will be taken care of. So the supply shortage is supply shortage is only on that one component, the semiconductor. And the second one is commodity prices, which have the kind of increase that we have seen is about the highest that I can remember. So the first one, supply shortage, will affect the overall production and therefore sales volume, and the second one could have an impact on profitability of various companies. The good side, though, is that right now the costs are being managed extremely well, and therefore the ability of the companies to take on the sort of impact of commodity price increase, I think, is better than what it used to be in most of the previous times. So therefore, we will have to see how we manage it. And I think we have been talking for many years, and every time this question comes up, that will we be able to manage our operating margin because of commodity price increases? And our operating margin has always been managed. However we do it, it's always been managed. So this will be the one big issue in terms of automotive. On the tractor side, I think there is very little to be concerned about as an industry because, again, I don't recall everything sort of aligning so well to drive the demand and the volume in tractor industry. So I would have to say that on tractor, nothing to be worried about. I'll come back to auto one more point. One fear that I have in auto is too much regulation coming in too soon. And there are talks right now about 2 or 3 other regulations coming in the next 6 to 12 months. And these kind of things will have a negative impact because of prices going up as a result of regulation. And therefore, my request always has been to the government to just ease down on regulations for a while till the industry sort of smoothens out and all the sort of COVID after effect are taken care of. At the macro level, Nikunj, I would be most concerned in India about employment. And now it has nothing to do with the industry that we are in. But the reason I'm concerned about employment is not that economy will not come back to the level that we were in at FY20. But during COVID, we have all learned how to manage with less. And once we have learned how to manage with less for the same level of economic activity, I think the employment will be lower. And therefore, how do you make up for that loss of employment is going to be one of the biggest challenges that we are going to face. I'm not so concerned about liquidity. I'm not so concerned about cash flow overall. My only concern is on employment. And then the geopolitical. What might happen because of the various tensions that we have at the borders, both economically and otherwise, is something that one will have to be concerned about. So I would say that my concerns are less business related. My concerns are more macro. And if macro does not create a situation which is unmanageable, I think business, at least the businesses that we are in, our core business, will do quite well.
One last question, Dr. Goenka, which is that pre-COVID, we were all trying to understand that what impact will shared mobility have on future of cars. Mr. Mahindra himself has gone on record and said, look, using Uber or using shared mobility is the new mantra. And there was little incentive for somebody to buy a car, which also was considered as a depreciating asset by a lot of millennials. We're not talking about that fear. Is it because of COVID, the shared mobility fear, which in a sense first gave demand to autos and then it impacted their demand, is a fear which is over now?
No. So first of all, let me clarify that shared mobility, when Mr. Mahindra talked about of what might happen, that was pre-COVID, was not a fear. In fact, we saw it as an opportunity in some sense because that creates a new vertical of supplying vehicles for that purpose and specifically designing vehicles for that purpose. Having said that, yes, shared mobility has taken a backseat. There is little less sort of comfort in sharing a vehicle with somebody or getting into a vehicle that you don't know who got into just before you. So there is a little bit of that fear. And I think it's going to be transient. I don't think this fear will remain forever. So what the reasons that drove shared mobility, those reasons have not gone away. And once the fear of infection or COVID goes away, and which should happen once the vaccines are all done, I think I would say in 4 to 6 months, people will still be careful still hopefully be sanitizing, be wearing masks and all that, but the fear of getting infection will go away. And therefore, I think shared mobility will come back about 4 to 6 months from now. So that's a statement number one that I want to make. Now, if you look today, the shared mobility part when it comes to last mile connectivity, which is use of auto, and last mile delivery, which is using an electric vehicle. Our Trio Zor, for example, is doing extremely well for last mile connectivity, last mile delivery. So I think that segment is growing fairly well. The personal segment, which is where we had stayed out of till now, is also beginning to pick up. Now, right now, the total volume in India are 500, 600 a month. So it's not something to cheer about. But I think that's just the beginning. So I would say that post-COVID-19 fears are over. Electric vehicle movement will start from where it left off. Okay, we have taken a setback. I won't deny that, about a year or so. But I don't think that momentum is lost forever. It's going to come back once the fear goes away. And one advantage that Mahindra has specifically, that our products, where our focus is on SUVs, and now as we do a new brand narrative, our focus on SUVs becomes even stronger, more sort of directed. For us, the SUVs are not replaced by shared mobility. What is replaced by shared mobility are normal, your everyday sedan and hatchback, but not the SUVs. And you have seen that SUV demand just is going through the roof. I would have never imagined that SUVs will represent 33, 34% of total passenger vehicle. If you had asked me 5 years ago, I would give you best number is 25%. So therefore, that segment is in some sense protected from the onslaught of shared mobility and reduction in demand. And I think that writing you are seeing on the wall anyways, if you were to analyze the data over the last 2 to 3 years.
I'm tempted to ask you one more last question, Dr. Goenka, which is that right now things are looking up. There is a constraint in terms of auto components that is having impact on demand. Demand is looking good. But what are the chances that the demand, which right now has got ignited because of COVID and because of revenge shopping, could actually start diluting itself in the second half of this year? And that's the time trouble and discounts and margin pressures will start.
You're talking automotive again, specifically?
That's right, sir. Because right now things are looking good. Right now everybody's excited. You are excited, I'm happy, nobody's complaining.
So Nikunj, keep in mind that while right now things are looking good and one may think that will it stop, but let's look at it on a larger or longer time scale. Last year, FY20 was a degrowth for the passenger vehicle industry. Okay. FY21 will also be degrowth, minus 10% at best. Okay, right now for the year we are running at about minus 12, minus 13%. I'm hoping we'll end up at minus 10%, right? So therefore, if you go into FY22, you are starting at almost, I don't have exact number, but my guess is you're starting at almost like minus 15% of 2 years ago, right? So therefore the demand should continue for 2 years because you have not yet even reached FY19 level in FY22, even if you had 15% growth. I hope I haven't confused everyone with the numbers, but what I'm trying to say is that in FY22, SIAM actually is predicting a growth of more than 20%. I think that's a bit too optimistic, my personal view, but high teens should be very doable. And even with a high teen growth in FY22, we won't have reached the FY19 level. So we have a lot of room to grow. One cannot say demand will stay forever and ever, but at least I think, unless something bad happens, something else hits us, I think for next 18 months, we shouldn't have to worry about demand. And the budget clearly is going to help us in the demand. And we haven't talked about that scrappers policy today. That, of course, will make another huge difference if that is done in a very sort of prudent manner. So right now, it's a good time to be in the auto industry. I think if you have good product pipeline coming in, any company that has a good product pipeline coming in, any company that has a good pricing, dealer network, should be looking ahead to amongst the best years that a company has had. I'm talking generally, I'm not talking Mahindra specifically.
All right. Thanks so much for joining us, Dr. Goenka. Great speaking with you as always in detail as to how the industry dynamics are shaping up right now.